Hello, everyone. Welcome to today's session. Let's get underway. Uh, we're going to, over the next couple of weeks, I'm going to be testing some YouTube Live, and not quite there yet. There'll be some links posted. I'll give you some more information when we get to that point. But as of right now, we'll continue with the GoToWebinar, but we're going to be doing some testing on that. That was on my mind just because that was part of my delay here, but very, very similar feel as far as how you access it, what you can view, and then being able to watch the recording on YouTube. But that is coming. So again, typically on the registration, when you're registering for these webinars, you come out to live online classes, go to this registration link. I've got the links to the classes here. These are the ones to GoToWebinar, but I'll add something here if that's the case. But to keep an eye out for that, potentially next Tuesday. Probably won't do it on Thursday, but just a little public service announcement there, I suppose. Market conditions we're getting a little bit of a pullback here today, seeing our overall market conditions. We know that we're at the upper end of this range, real long-term uptrend, finding some support in the short term, getting a rally, and running into some resistance now. We'll take a look at, I've got to update this momentum line here as well, but this is not extreme. We're in this upper end of this range, having a consolidation. We've talked about this now for a couple of weeks. Let me actually jump over to S&P 500. I'll come back to buy-sell ratio, but S&P 500, this chart pattern here, where we're looking at this range now, this 554 range and this 565 range. We've had three attempted support ranges, that 554 range, and today could be another one here. If we slide through that one, then that 548 range is going to be the next stop. But we are at this upper end of the range. The markets have been concerned about interest rates, inflation, profitability, and recession. Really, those have been really the main talking points in the market. Are we going to get a Fed cut? Is it going to be a quarter point? Is it going to be a half point? Is it going to have? We're going to get several over the next few months. And that game with interest rates, and we've talked about that almost every session that we've had now for several months, because the real big giant boogeyman that's still sitting out there is this bond yield curve, and we know that. Okay, we know that is the issue, but what we don't know is what's going to be some of the collateral damage of this scenario. So there's always collateral damage in slowing inflation, but we just never quite know how bad that is when liquidity becomes an issue and the Fed is, easy money or tightening their policy and talking about that. They tend to just play all these really weird games in terms of what are the Fed meetings saying? What are they hinting at? Are they dovish? Are they hawkish? Are they going to ease the policy? And that's the biggest issue right now: is are we going to have some easing policy, meaning interest rates are going to be coming back down, and is that too late in this cycle to prevent a recession? Typically it's not. Almost always there's an inverted yield curve, we do get a recession or a slowdown of some kind. And so that's, but when we actually see that starts to happen, the market is usually sold off already. So right now we're just in this anticipation mode. What's going to be happening? Where are we at? S&P 500, if we look at this perspective, it's really not overly concerning today, because we're still in this upper range, 553. But in that same breath, I could say that the fact that we are at resistance and potentially looking for or could have a bit of a slide, I think it would take a decent catalyst around those topics, a decent catalyst around interest rates or around inflation or around recession. If something, and along with recession and inflation, you're dealing with consumer price index, you're dealing with all these different measures. I think the Fed, in terms of their inflation numbers, I think I read they're back to 2.9. It might have been 2.6. And that's their mandate is typically 2% annual inflation. So they try to manage that the best they can with the best tool they have, and that is liquidity. That's the money supply, that's interest rates. So right now we've got the market that's saying, back here the market was saying the Fed may have raised interest rates to the point that we are now bleeding over into a recession, and that created some fear. Well, in almost the same week, we get some economic numbers that actually were good, to the point that the market said, oh, these are good enough that the Fed is more than likely going to cut interest rates. We're going to have to cut interest rates and maybe get a little bit more of a soft landing. Soft landing meaning not a recession, or a really mild recession, if that is the case. So lots of, when we're dealing with markets and we're dealing with the future and we're dealing with unknowns, we're dealing with that. We're dealing with what we don't know. And obviously we can't see into the future, other than the fact that the Fed typically does things very similarly each time, and they're usually right overall, but they're usually late, and they're usually early. And so in this case, you're seeing now, I think one of the biggest issues is the consumer market in the mortgage space of home building and mortgage refinances, because we as consumers, we love to tap into those into the equity in our homes and then go spend it, right? We want to or do something with it. We're adding on, we're putting in a pool, we're getting a hot tub, we're going on a vacation, and we're pulling that money out with relatively low interest rates, or at least that had been the case. Now, you're 6.5% on mortgage rates, and that's, and for new home purchases, that's a pretty expensive mortgage still. So if consumers start to feel pinches, or if the economy starts to slow down and we see companies laying off their employees, and then that issue, kind of a trickle down effect of companies are having issues and therefore their employees are having issues, and then they're trying to pay an expensive mortgage, or they're trying to get into a home, or they're trying to sell a home, then you get all of these scenarios that start to spill over into the market where interest rates are high. Now it'll be curious to see, and I mentioned this last week, is if we see more home prices really start to drop, because rates are so high, and people that need to sell are going to be forced to sell their homes at lower and lower prices, because the buy side, those that are trying to get mortgages, can't afford anything higher than that, but people need to get out of their homes. So that's all a marketplace is. In the stock market, we get kind of spoiled with liquidity because we can buy and sell instantly. In the real estate market, it's way harder to do that. It's a very slow process to find, for the market making process to find equilibrium, meaning a buyer and a seller actually come to the meeting of the minds, and that and that's a slower process. To me, you get these weird these feels of what's happening in your own area, and that's a concern. That's a big concern, is the price of real estate and interest rates. Still, even if the Fed cuts by a quarter point or a half point, and maybe that brings interest rates down and mortgage rates down to 5.5%, even 5%, on a $600,000 house, you're still paying $4,000 a month. That's, for if somebody that's in a tight financial situation, that becomes tougher and tougher. So that's kind of the thesis. I call it a thesis. We're kind of speculating, what if this, then what? Okay, if this, then this kind of scenario. And it doesn't always pan out that way, but a lot of times it does. So price activity in the stock market is not quite that cut and dry, but in essence, it kind of is. People are buying and selling, institutions are buying and selling stock in the market based on what they anticipate is coming, and instead of what actually is happening. And that information is, going to show up at certain locations. So let me go back to the 1 year or the 6 month time frame, S&P 500. So these are the ranges that we want to be aware of. A portfolio allocation, I think we're at about 35% equities, and a little bit probably going to be lower than that. I think we're going to get stopped out of a couple of positions today, and then starting to look to see how this holds up. I'll go way back to lighter again in terms of the number of holdings, trimming some winners, trimming some losers on a day like today, unless we get a significant bottom. If we start to find some support right here, and then we do get a bottoming tail bar, because we're right in the middle of this downturn, if we get a rally back up at all, that's going to create a wick, kind of these candlestick wicks. I call them topping tail bar or bottoming tail bar. They're called a lot of different things, but essentially that wick tells you where the price activity has been. That's a decent sell-off right here on S&P 500. September notoriously has been a down month historically, and so we'll see if we get some of that seasonality here as well coming into September. We did last year, September 1st. What are we at? We're the 4th. This was September right here. So early in September, we had this activity taking place in the month of September. Again, that doesn't always necessarily have to happen, but I had read a report that we've seen that September is pretty consistent. And then you get September, October downturns, and then you get a Santa Claus rally. Okay, so we could see some of this coming into this month, and then you get the November, December rally. They call that a Santa Claus rally going into the holiday season. It doesn't always happen that way, but this may be the real early indication of some retracement. We want to be aware of that, certainly because we know that the market is super skittish right here. This tells us that this is a really jumpy market. This is a really FOMO market. Everyone's quick to sell, but everyone's really quick to jump right back in again. Okay, so that's going to unfold over the next few weeks as well. We'll see if this starts to happen again. A little bit more of that panic, a little bit more of that skittishness saying, oh gosh, yeah, the Fed is way late and we already are in recession, and we're going to need some economic numbers and some earnings reports and some various data to be able to give us some more information there as well. But in terms of today, the market is not liking something that just simply could be coming back from a holiday weekend and a natural retracement location at on the Dow. We're sitting at all-time highs and getting a bit of a retracement back down again. Again, nothing too significant, 1.5%, not too big of a deal yet, but this is where it begins. This is that first day of potential retracement. We want to watch that's the structure of that a little bit, watching your stop loss locations and trimming losers. Okay, you typically want to trim the losers out first, the ones that just aren't performing. They didn't ever take off. Market conditions play a major role in that. If we're buying into stocks and the market starts to roll over, those stocks are not going to perform. It just is the way that it is. The market is the market, and we don't want to necessarily fight it. And we are at the upper end of this range. Here's that Dow rally. It could use a healthy retracement, and that may create some more buying on a pullback right here, which we really haven't had. That's a little bit more of the market structure currently. SPY 1.5%. Again, if we see some acceleration, we're going to want to watch to see where we find the next really rung of support. There's a lot of support right here. You can see this area, that 548 range. If we get there today, then we'll want to see some support happening. If not, then and get a counter trend and it breaks through that 236 and that momentum, when we get back into this range, that's an area of price activity that we're really going to want to lighten up again and go way, go back to pretty small position sizes on the overall holdings. Let's see how SHY. So SHY, a little bit of a gap lower here. I haven't looked to see really what talking points are coming up, but again, interest rates. It's interest rates. It's recession for the most part. TLT up a little bit today, and SHY is that short-term treasury, that 1 to 3 year treasury, pulling back here just a little bit. If we jump over and take a look at sectors, we're seeing sectors actually looked pretty good as of this morning. Let's see if we do have anything moving. Yeah, it's just this month. You can see some of these month to date, or I should say rolling month. These are not month to date, but these are rolling month. 30-day period of time. That's 8. We had a decent August, a decent prior 30 days, and we'll see what we get going forward. The sectors, commodities also. We take a look at gold. Let's see if we're getting any breakout on gold. I don't know why this thing's running so slow today. Had a couple of small data issues this morning. I think that's a part of that's happening. But once that gets loaded in here, we can take a look at gold. Once just taking its own sweet time. Hope everyone had a great weekend. That Labor Day weekend, kind of the official end of summer, and hopefully everyone had a went out with a bang, a little pool party and a barbecue of some type. There we go. So gold, a little retracement here today. We'll see if we get some support. Gold has also created a relatively tight range, similar to that S&P 500 pattern. We've got some support here, that 228 on GLD and 234 ranges. If we can get some support here, that could set up for a nice springboard on gold. And keep an eye there. Certainly, I think we're getting stopped out of our gold stock. We haven't had much success this year, honestly, with a lot of these gold trades. We had KBH, or not KBH, I can't remember the symbol, a little bit of a gain here, but a lot of these these gold stocks, we had the breakout here, retest that stopped a few things out, new entry that gets us into some trades, and then a big enough retracement to stop out of a few things. That's the way the cookie crumbles. Sometimes we get in, we get some stops, we get some winners, we get some losers. SLV, let's take a look here. SLV also having a decent retracement today, pulling all the way back. And then USO, see what it's doing right now. Wow, USO is getting hammered, 4.5%. So oil seeing a significant downturn. Let me go out to that 1 year time frame, all the way back down to that 71 range. It looked like it wanted to find some support right here, but really got caught in just this entire range right here. Tons of volatility on USO, and so we could see an attempt. If we don't get a support range right here, we could see a pretty decent slide all the way on USO. There's a big range of support resistance here. I should say support now, but the next real major support area is all the way down here on USO, and that's fine. I never care if oil's dropping for the most part. That's, unless we're in gold trades, but I'd rather have oil trades. I'd rather have USO dropping as a whole, and especially right now, if we can get interest rates to come down, oil to come down, and that's only going to really help economic perspective and some profitability there. Muscle stock group, let's jump over and take a look. We actually added into CRBP this morning, getting some volatility here, pretty quick, 6%. This was a right at resistance area. We've got a stop loss down here. So essentially what we're allowing for this much of volatility, that much range to say, let's give it a shot. We would have liked to break out, but sometimes we get these retracements. Again, this is purely market driven, market condition. When the market is down, most stocks are also going to be dealing with retracement, because that's all the market is. The market is just all of these individual stocks. So we'll see here if we get some support before we get close to that stop loss. That was CRBP. NRG, this was an interesting stock. It looked good at the open, but getting some resistance, some retracement back to that 80 range. That's also in that utility. A lot of times we're seeing fear or a little bit of panic happening. We'll see some strength in utilities, not so much today on that price pattern. But let's go through a few of these names as we go through looking at the new buy list. That's one of the functions there, is you can go through and just on these drop downs, go to the new buys, and then you can scroll through and look at and just arrow through these. And we've seen a lot of these names that they just really wanted to make an attempt here. Remember, we deal with whipsaw. That's just a function of the methodology. It's a function of trading as a whole, and that is waiting for a confirmation move higher, getting the confirmation move, and then having it immediately reverse, and then either dealing with a stop out or a support area, and then you get more upside. Obviously, if you get more upside, it'll go back to green and we can take another stab at it. But whipsaw is just just a part of the deal, okay, right here as well. For momentum strategy, for breakout strategy, it's a part of trading in any methodology, and that is when you have a direction or you're anticipating something to go one way and it immediately goes the other way, or you get your confirmation signal that you're waiting for and then it just fails. It just doesn't work. We're seeing that in this case, a couple points of some potential stop outs there, and those are decent moves. Those biotech names also can be pretty aggressive to the downside when you do see market starting to take a risk on scenario, and that is selling, going back into conservative trades, these biotech names are pretty aggressive. RYAM, this was an interesting stock that showed up in the scan yesterday. Really volatile. Had an earnings report that gapped higher. They are in the paper related products. So let's talk about a trade setup right here. Again, as we're going through our patterns and we're going through our trade scenario and we're looking for opportunities, then we're taking our top-down approach and we're saying, what's the market doing? Market conditions are bullish. They're in an uptrend, but we're extreme to the upside. We know that. Okay, so we can say, I don't want to take a trade right here just because of that. Or I want to take a smaller trade, or I'm going to take a full position trade. Whatever this means, most of the time it means just either don't take a trade or be aware of the position size, and that's the real value of the top-down approach. What is the market doing? Are we in a nasty downturn? I don't want to fight that. Are we in a really strong uptrend, which we are right now? I still want to take trades because of the FOMO. You get a lot of skittish selling, but you also get quick buying into those in these market conditions until that stops happening. It hasn't yet, but now I would say, all right, at least for that perspective, let's start there. Buy-sell ratio, we could come in and say, yeah, we still have a positive buy-sell ratio. All right, let's find a stock. We've got a stock. It's got a new buy signal, a nice confirmation move. And again, this is as if we didn't know what happened today, and we'd say, here's our setup. Now, what is my risk? How much of a position can I afford, or am I willing to take based on my trading plan? My trading plan says I'm going to allocate 2% of my entire portfolio towards this trade. Then I can come in here to the portfolio tab and I can say, I've got, how many shares can I buy? Okay, at $8 a share, if I said 100 shares, that puts me at 0.74. If I went up to 150, that's 1%. That's still too light. Let's go to 200. I can even go up to 250. Let's go to 280. Oops, 280, not 180. So let's go to 270. So there's 2% even. Okay, so my portfolio at risk is 2%. Okay, what that means, that $2,000 is worst case scenario, that's my maximum loss. Worst case scenario is that this stock goes from $8 to 0. Okay, the probability of that happening, you can see it can drop pretty significantly, but it's probably not going to drop to 0. And we know that we're not going to risk that full amount. We're going to use a stop loss as well. So now we want to say, well, where should my stop loss be placed? If we just take a natural stop loss location right below the 236, okay, a tighter stop would be underneath all of this price activity or the low before the most recent hold signal. So you could go here. Let's look and see what it's at this low, 694. Let's call it 680. And see what that number looks like. If I go 680, that puts me at 0.24 or $250 at risk. That's a 12% stop. Okay, so that's all the way down here. That's not bad. That gives me enough room to say, it's, retrace today, maybe tomorrow it comes back down, maybe it finds some support here, and then it starts to move higher. If not, maybe it finds some support down here. I'm okay with that. If you're not okay with the chance of it moving back down below a certain level, make sure you place your stop loss there and get out at that level. It doesn't mean that you're dumb. It doesn't mean that you made a bad decision. It doesn't mean that you're a bad stock picker. It just simply means I've got to manage my money. And the market is going to do what the market does. Okay? We have no control over what's going to happen to this stock or what's going to happen to any other stock or what's going to happen to the market. We look for opportunities of momentum stocks that are increasing, that are breaking out, and that are doing so on increased volume, okay, and doing so in a good market condition. And if we want to add a couple of other things, I'll cancel this for now. We could potentially add some other things and say, they've had their earnings are increasing last quarter. Okay, that's why they had this big gap. More than likely was their earnings. This was probably a massive surprise, and it gapped higher, and now you're getting some momentum saying, whoa, what's happening with these guys? Why are they moving higher? And then you can start to ask some of those questions. Those questions may or may not be helpful to the trade, but it may help you understand why there might be some interest. And it's almost always earnings. Okay, it's got to be earnings or growth of some kind that the stock is interested in. It's not interested in anything else. It might be interested in, okay, they have a new product, they have a new CEO, they have a blah blah blah, whatever it is does that mean they are going to be profitable? Are they cutting costs? Are they doing what are they doing to make the company more and more profitable? That's all the stock cares about. If it has to do anything with that, then the chances of it going higher are increasing, they're improving. But we also a lot of times have enough information here to say there's a big move, increased volume, upward momentum, had a big earnings, then okay, we're at a price location that we could take a trade on that. And we figured that out, that our risk was at $250 based on that trade. If you have a smaller trading account, obviously it's going to be a smaller number of shares, and that might be set up to be, I need to add a $10,000 portfolio, so we can do that once in a while and just look what those numbers look like. But let's assume that this is 10,000 and we're saying, okay, what's 25 shares or 20 shares? That's a position size of $150. Okay, so if I have a $10,000 account, I could go a little bit more than that. I could go 30 shares. That's even too high, 25. That puts me at $193. 193 is going to be 1.93, that's a 9, 1.93% of 10,000. Okay, so it's a smaller trade, but that's the risk that you have to be able to take. Doesn't matter your account size. If we're saying I'm going with around 2% and I have 2,000, I've got to go 25 shares, $193. If I get stopped out, let's put that stop price back in there at 680. Then I'm out $23. That's still a 12% stop, but instead of $235, it's $23.50. So if my account is smaller and I'm putting on the number of shares, then this would be my risk for this trade, $23. Of my $10,000, I'm risking 23 to take this trade. Am I okay with that? Is it too small? Is it too big? Okay, that's only you can answer that question based on what your risk tolerance is and your ability to be able to take on more and more trades. But these two numbers, the portfolio at risk, stop price, and then you're dealing with your account size to manage the overall number of shares. Okay, and that would be a process for a trade setup, and it could be on any stock. We just pull in. We're typically looking for the new buy list and looking for opportunities like that, a good solid bar, and then it ends up gapping a little bit lower this morning, so we get in at a little bit lower price than we would have at the close yesterday. That could be good, could be bad. It ends up just giving us a lower price, but we'd still maintain our stop loss. So we actually now, if we were to take that trade, we end up with a little bit less risk. Instead of that 12%, which was based on around that $8 number, would be more like maybe 10 or 11%. So our stop naturally becomes tighter because we end up entering at this location. That is, if we set up our market or our limit order to buy at the market open, it's going to buy at the market open right there. Again, I'm going to end on that note. Appreciate everybody's time and effort, and I'll try and give you plenty of time to know if we're going to go into that Facebook or not Facebook, YouTube Live versus GoToWebinar, but probably won't be till next week, and I'll make sure that I post something on that webinar registration page. And that'll do it for today's update. Everyone have a fantastic day today. Bye now.